On March 27, 2022, Indonesia's finance minister delivered a speech that received little attention in Western media. But inside central banks, from Beijing to Riyadh to Moscow, every sentence was analyzed carefully. She said, "We must begin thinking about a payment system that does not depend on the currency of any single country. What happened to Russia could happen to anyone." Just 3 months earlier, the United States and its European allies had frozen $300 billion of Russia's central bank reserves overnight, instantly inaccessible, untouchable. At that moment, finance ministers, central bank governors, and sovereign wealth fund managers around the world all asked themselves the same question. If it happened to Russia, could it happen to us? Welcome to Market and History, where we decode the financial changes shaping your future by linking them to the patterns that have controlled wealth and power for centuries. Today, I'm going to show you something unfolding right now, something that may determine whether the cash in your wallet, the savings in your bank account, and your long-term investments hold their value over the next 20 years. Because we are witnessing the beginning of the end of an 80-year financial order, not the end of America, not the collapse of the dollar, but the end of dollar exclusivity, the era in which the world had to use one currency, hold one country's debt, and operate under one financial rule book. That system is being dismantled quietly and methodically, piece by piece, while most people remain unaware. Before we look at the data, before I explain what is being built to replace the current structure, do one thing first: subscribe and turn on notifications. What I'm about to explain is rarely taught in economics classrooms. Many financial advisors don't fully understand it, and the media reports fragments of the story without connecting them. When this transition accelerates and affects your portfolio, you'll want to have seen it coming. Also, comment below what percentage of your net worth is denominated in US dollars, your salary, savings, and investments combined. If that number is above 70%, you should pay close attention to the next few minutes. Let's begin with a number that should be shocking, though most people never noticed it because the change has been gradual. In the year 2000, 71.5% of global foreign exchange reserves were held in US dollars. When central banks decided where to store national savings and emergency reserves, roughly 7 out of every $10 went into US assets, mostly Treasury bonds. This gave the United States an extraordinary privilege. It could print currency without triggering domestic inflation because dollars flowed overseas. It could borrow cheaply due to constant global demand. It could run trade deficits indefinitely because other nations needed dollars as reserves. This was the foundation of American financial dominance. Now fast forward to today. According to IMF data published in January 2025, the dollar's share of global reserves has fallen to 58.4%, a drop of 13.1 percentage points in 24 years. Yes, the dollar is still dominant, but the trend matters more than the level. If the same decline continues, the dollar will eventually become one reserve currency among several, not the reserve currency. And when that happens, interest rates, inflation, borrowing costs, asset prices, salaries, and savings all change. But here's the critical point: that missing 13% didn't disappear. It moved elsewhere. The euro rose slightly. The yen and pound gained marginally. But the fastest growth came from the Chinese yuan. It went from essentially zero reserve status in 2000 to about 2.3% today. A small number, yet a massive structural shift in a decade. Another destination for capital has been gold. Central banks purchased over 1,000 tons of gold in 2023, one of the largest buying years in history, and nearly as much again in 2024. Major buyers included China, Poland, Singapore, India, and Turkey. They weren't speculating. They were reducing exposure to an asset that can be frozen and increasing exposure to one that cannot. Now let's look at the US Treasury market, where this shift directly affects you. The United States currently carries about $36 trillion in national debt, increasing roughly $2 trillion annually. To fund that gap, the government issues bonds. For decades, foreign buyers, especially Japan and China, absorbed a large share of those bonds. Foreign holdings peaked in 2021 and have begun declining. China alone has reduced its treasury holdings by over 40% in about a decade. This matters because if foreign demand falls, someone else must finance the debt. Domestic investors requiring higher interest rates, the Federal Reserve risking inflation. Or government austerity. Now, politically unlikely higher Treasury yields mean higher mortgage rates, directly affecting households. To understand why this system existed, we must go back to 1974. The United States reached an agreement with Saudi Arabia. Oil would be priced exclusively in dollars, and the US would provide security guarantees. Other oil exporters followed. The result, every country needed dollars to buy energy. This created permanent global demand for the currency, the foundation of the petrodollar system. In June 2024, that exclusive arrangement quietly ended. Saudi Arabia announced it would accept multiple currencies for oil. For the first time in 50 years, energy trade no longer required dollars. Now connect this to a larger development, BRICS. Originally formed in 2009 by Brazil, Russia, India, China, and South Africa, the group expanded in 2023 to include major energy producers and strategic trade hubs. Together, they represent a massive share of global population, production, and resources. Their stated objective, build financial infrastructure independent of the dollar. They are exploring a shared trade settlement unit and digital platforms to facilitate cross-border transactions without using US financial rails. And the infrastructure already exists. China built SIPs, an alternative payment network to the Western-controlled SWIFT system. Russia built SPFS. Other countries are linking into similar systems. These networks provide redundancy, so nations cannot be isolated from global finance through sanctions. This is not a sudden collapse. It is a gradual transition toward a multi-currency world, and the consequences will shape the value of money, investments, and economic power for decades. Perhaps the most advanced alternative system currently under development is something called mBridge. It is a central bank digital currency settlement platform being tested by the BIS Innovation Hub together with the central banks of China, Thailand, the United Arab Emirates, Hong Kong, and Saudi Arabia. The concept is simple but powerful. Central banks can complete cross-border payments directly with each other using digital currencies, without correspondent banks, without SWIFT, and without relying on the US dollar. The pilot program began in 2023, and by early 2025, it had already processed billions of dollars in experimental transactions. If implemented at full scale, it would fundamentally change global trade settlement. Today, when a Thai company pays a Chinese company, the transaction typically passes through the dollar system. Baht is converted into dollars, routed through the US banking network, and then converted into yuan. Because the payment touches the US financial system, it becomes visible to US authorities and potentially blockable. With mBridge, the payment would move directly from the Thai central bank to the Chinese central bank, instantly converting baht into yuan. No dollars involved, no US intermediary, no external oversight. Now you might think, but the dollar is still dominant and these alternatives are small. That is true today, but the trajectory matters. 10 years ago, the yuan represented virtually none of global payments. Today it accounts for about 4.7%. 10 years ago, KIPS did not exist. Now it processes roughly $350 billion daily. 10 years ago, mBridge was only an idea. Now multiple central banks are actively testing it. The point is not that the dollar disappears tomorrow. The point is that the infrastructure allowing countries to operate without it is being constructed right now, and the pace is accelerating. Let's look at history, because this pattern has happened before. In the 1700s, the Dutch guilder served as the world's reserve currency. Amsterdam dominated global finance and Dutch merchants controlled international trade. Then Britain rose. Over about 50 years, trade gradually shifted into pounds instead of guilders. Capital moved from Amsterdam to London. By the mid-18th century, the pound had replaced the guilder. The Netherlands did not collapse. It remained wealthy, but it lost global financial influence. The same pattern repeated in the early 1900s. The British pound was the world's reserve currency. London was the financial center and British bonds were the safe haven asset. Then the United States rose. After 2 world wars and the Great Depression, the 1944 Bretton Woods Agreement formally established the dollar as the global reserve currency. Britain remained a rich nation, but it lost the ability to borrow cheaply, run constant deficits, and print money without immediate inflation. Its relative global power declined. Today we are entering the 3rd great reserve currency transition. The dollar is not being replaced by a single rival. Instead, it is gradually being diluted embedded inside a multipolar system, one important currency among several rather than the exclusive one. This change will take decades, not years, but it is underway, and its consequences will be significant because the privilege the United States has enjoyed for 80 years, printing money absorbed abroad, borrowing cheaply, and sustaining deficits, is fading. Imagine a world where the dollar represents 45% of reserves instead of nearly 60%. First, interest rates would stay structurally higher. Lower foreign demand for Treasuries means higher yields to attract buyers. Mortgage rates could rise toward 8 to 9%, car loans around 10%, and credit cards near 25%. Second, the dollar weakens. Imports become more expensive. Electronics, fuel, clothing, feeding inflation. Third, government budgets tighten. Higher interest payments consume more tax revenue, leaving less for social programs, defense, and infrastructure. Taxes rise, spending falls, or deficits expand further. This is not economic collapse. It is simply normality. For most countries in history, borrowing cheaply in their own currency was impossible. The United States has been the exception because of reserve currency status. As that fades, America becomes more typical, still wealthy, but less exceptional. So what can individuals do? First, understand your exposure. Income, savings, investments, and property are all priced in dollars. If the dollar loses value globally, so does your purchasing power. You cannot remove that exposure entirely, but you can reduce it. 1. International diversification. Own some non-dollar assets, foreign equities, or global funds. If the dollar weakens, those holdings rise in dollar terms. A 20 to 30% allocation abroad is reasonable. 2. Commodities and real assets. Oil, metals, and agricultural goods retain value across currencies. Companies producing them act as hedges against dollar weakness. Real estate may also rise with inflation, though variable rate debt becomes risky. 3. Gold. It produces no income, but it carries no counterparty risk and cannot be frozen or printed. A modest allocation, around 5 to 10%, serves as insurance during currency transitions. 4. Skills and earning power. In a slower growth world, human capital matters more. Develop globally valuable skills and income sources less tied to one economy. 5. Reduce high interest debt. If rates rise structurally, expensive debt destroys wealth quickly. Eliminate variable rate obligations aggressively. Psychologically, this adjustment is difficult. Americans are used to dominance feeling permanent, but history shows every reserve currency eventually yields its role. The guilder did, the pound did, and the dollar will as well. Not because America is collapsing, but because the rest of the world is catching up. The United States will remain powerful and innovative, but losing exclusive reserve status will feel like decline even if prosperity continues. The goal is simple. Ensure the shift in global monetary power does not translate into a decline in your personal wealth. We are moving from a unipolar financial world to a multipolar one. You cannot stop it, but you can prepare for it. Diversify exposure. Own assets that hold value across currencies. Position yourself for the world that is coming, not the one that already passed. That is Capital Explained, the long-term perspective on forces unfolding over decades, not days. The new monetary order is not a distant theory. It is being built right now through trade agreements, digital payment systems, currency swaps, and central bank diversification. When the infrastructure becomes fully operational, the transition will accelerate. Prepare while the dollar is still dominant, because those who wait until change is obvious pay the highest price. I'll see you in the next one.